Hi. If you have not yet read the bond section of Chapter 10 or watched the interactive presentation on Connect relating to bonds, please stop this demonstration, read or watch it, and then come back to view the presentation that I'm doing right now. It will make a lot more sense to you. And by the way, you can also print the worksheet that you see in front of you. It's in the Chapter 10 folder in Mod 3 in Blackboard. What I'm going to do instead of using a book-based problem or a problem on Connect is to use this worksheet that I've developed, because the only difference between problem 1 and problem 2 is the quoted bond price, the selling price of the bond. So I thought that would highlight the differences between a premium and a discount. Okay, so let's take just a couple of minutes to review what causes bonds to be issued at prices different than the face value or principal of the bond. When a company wants to raise money, we call that debt financing, by selling bonds. The process takes quite a length of time. First, the reason for borrowing and the specifics of the bond contract have to be decided upon. Then the shareholders have to vote on it if it's a public company. The prospectus has to be approved by the SEC. Then either the company or investment broker sells the bonds. So if when you first prepare that proposal, you anticipate that the market rate of interest when the bonds finally sell will be 4%, so you set your bond stated interest rate at 4%, and then the market rate ends up being 5%, no one will want to buy your bonds because they can get 5% by buying another financial investment. So you induce them to buy your bonds by selling them at a discount. A discount in bond quotation prices would be less than 100. So something like 97, 98, 95, that would indicate that you're selling the bond at a discount. So perhaps you sell a $1,000 face value bond at 97 or 97%, which is for $970. You collect $970, but you have to pay back $1,000 when the bond becomes due, which is at maturity. The bondholder gets the extra $30. They also get the bond stated rate of interest at 4%, and added together, the price break of $30 and the stated interest rate of 4%, it approximates the 5% market return that the market rate was offering. Everyone gets the same deal because bonds are priced to yield or return the market rate of interest. We adjust the selling price to give everyone the same deal. So what if the market rate you anticipate will be 4%, so you set your bond rate at 4%, but the market rate ends up being 3% when you finally sell the bonds? Well, then everyone will want to buy your bond because you are offering more interest, 4%. than other financial investments are, which is 3%. But since we have to price bonds so that everyone gets the same deal, which is the market rate of interest, we will sell your bond for more than $1,000. Perhaps our bondholders will have to pay $107 or $1,070. So your company gets $1,070 and pays back only $1,000 at maturity. That sounds like a bad deal for the bond buyer, but remember, the bond buyers are getting a higher rate of interest, 4%, than other people are. They're getting 3%. So the higher interest payments received, less the higher selling price, the extra $70 they have to pay, ends up giving bond buyers the market rate of interest of 3%. So how do we determine whether a bond should be sold at 97 or 107? Well, we use the present value of the principal and the present value of the interest payments over the life of the bond, using the market rate of interest. Now, we won't be asking you to learn that, but that's how they're calculated. You can just look at the finance section of the Wall Street Journal to see what the bond quotes are. Okay, so let's take a look at these problems. In problem 1, January 1st, 2015, Joe's Garage issued $200,000 of 5%, that's the stated rate, 20-year bonds payable at a price of 95. That means 95% of face value. The bond pays 5% interest annually, which means once a year. Assume the accounting year ends on December 31st. Journalize the following transactions at Joe's Garage. So we first issue the bonds payable. The way we determine how much cash we're going to receive from the bonds, and I'll put the calculations in here, is to take the face value of the bond or principal times this price. But remember that represents a percent, so that's 95%. We don't see the percent sign, but that's what it really is. When we multiply 200,000 times 95%, we get $190,000. So you're going to receive $190,000, but at maturity, you're going to have to pay back the face value or principal. Let's put that as our credit here, our bonds payable credit. So you receive $190, you have to pay back $210. That $10,000 is called the discount on bonds payable. And that would simply be calculated by taking the $200,000 and subtracting the amount of cash that you're going to be receiving. Remember, the total debits have to equal the total credits. Bonds payable will always be credited for the face value. That's the amount payable at maturity. Now, as we take a look at that discount, the difference between receiving $190 now and having to pay back $200,000 20 years from now, it sounds like extra interest, doesn't it? And that's what it is. It's a difference between interest rates. You're paying 5%, perhaps someone else is paying more. But we can't call it interest expense right now, all on the day that the bond is issued, because this bond lasts for 20 years. Now let's take a look 1 year into the future. It's January 1st, 2016, and it's time to make our annual interest payment. I suggest doing the cash payment of interest first. It makes it a little bit easier. Let's figure out how much cash interest we have to pay. And to do that, we multiply the principal. It's a P times R times T formula. $200,000 in principal times the interest rate of 5%. So 0.05. And this is annually, so it's 12 divided by 12, and that gives us cash interest payment of $10,000. Now what we're also going to do is we're going to take this discount on bonds payable and reduce it by 1/20th. It's got a debit balance, so we're going to credit that account. Take whatever the discount is, in this case $10,000, and divide by the number of interest payments. This is a 20-year bond, and we pay interest annually, so we'll divide by 20. And that will give us $500. Now, why do we do this? Well, remember, the discount represents additional interest. You receive $190,000, you have to pay back $200,000, but we can't call it interest all on day one, interest expense on January 1st, 2015. We have to spread that $10,000 as additional interest expense over the life of the bond. That's what we're doing here. This is called amortizing the discount. We take the $10,000 in discount and split it up over 20 years. So your interest expense ends up being the addition of the $10,000 plus $500, or $10,500. So the amortization of bond discount ends up increasing the interest expense. The interest expense ends up being actually higher than the cash payment. Now, what do we do at maturity? Maturity is very easy. We just debit bonds payable for the face value, and we credit cash for the principal or face value. Now, we skip the other 19 years in between, but those 19 years would look just like this. Okay, now what if this is a premium instead of a discount? The only thing that's changed in this problem is that instead of a selling price of 95, it's 105. So let's do the same thing. We're going to debit cash for 200,000 times 105%, or 210,000. That's how much cash you're going to receive. But we're going to credit bonds payable for the principal. So you will receive $210,000 when you sell the bonds, but you only have to pay back $200,000. Sounds like a bad deal for the people buying the bonds, but remember, they're getting higher interest rates than if they bought other financial instruments. Your bond pays more interest than the market rate. So they pay a little more to get a little more. So that extra $10,000 will be called the premium. Sorry about the spelling. Premium on bonds payable. There, now our total debits equal our total credits. 1 year from now, January 1st, 2016, it's time to make the cash interest payment. Let's do the cash first. The P, or principal, times the interest rate, times the time factor, and that gives us the same amount of interest as in the situation in problem 1. We want to amortize a bit of this premium, though. The premium has a a credit balance. So we'll debit the premium on bonds payable to reduce it, and we'll take the 20,000, the 10,000, and divide by the number of interest payments, once a year for 20 years. And that will give us $500. Now what's the interest expense? It's just the difference between the two. $10,000 credit. We've only got $500 on the debit side. Debits have to equal the credits, so this is going to be 10,000 minus 500, or $9,500. Now why did we do this? We amortized the bond premium because, just like with the discount, this results because of a difference in bond prices. This reduces getting $10,000 extra up front and only having to pay back $200,000 actually is a reduction of your interest expense. But we can't reduce interest expense account all on day one. We have to spread that reduction out over the life of the bond, the 20 years that the bond is in existence. So that's what we do here. We divide the premium by the 20 interest payments, and each time we make an interest payment, we reduce our interest expense by $500. So when we amortize a bond premium, the interest expense actually ends up being lower than the cash we pay out. How could that be? Well, because they gave you extra money up front. They gave you $10,000 up front. We're just returning that money to them. So the amortization of a bond premium reduces interest expense below the cash payment. Those payments continue annually for 19 more years. When we pay off the bonds at maturity, just as in our situation with a bond discount, we simply debit bonds payable for the principal and credit cash. We don't have any interest payments at this point because we've been paying interest all along through the 20 years. So I hope that helps you understand bonds a little bit better and the differences between premiums and discounts. Remember, you can watch this over again. You can also watch your interactive presentations over again. And if you have any problems, please feel free to send me an email or give me a call. And alternatively, if you're on campus or near campus, you can visit the Accounting Tutoring Lab as well. Have a great day.